G'day. Welcome to the Investing Masterclass. Great to see everyone here today. Thanks for joining us. I'm Himangi. I'm from the team at Sharesight, and we're an online portfolio tracker focused on empowering investors by simplifying complex investment data and helping investors make informed decisions in their investment journey. Whether you're a beginner, an advanced investor, or a financial intermediary, Sharesight is here to help you bring institutional level insights to your financial investment journey and help you keep track of any form of holding that you have all in front of you, and so that you're always informed. As always, today's session is hosted by Vince Scully, CEO and founder of Life Sherpa, who is not only one of Financial Standard's 50 most influential financial advisors with over 35 years of experience. He's also the author of 2 best-selling books. Thank you, Vince, for session number 3 of the Investing Masterclass. Just a quick info. Whoever's attended the Investing Masterclass today and the series before, you get a good discount on Vince's book, Live the Life You Want with the Money You Have. More details to come after the webinar is over. So, now, the last session was all about strategies to optimize your portfolio, along with learning about how to add growth assets into your portfolio, basically where to start and how do we get that into our own investment journeys. All of these previous videos are available on Sharesight's YouTube channel. And I really urge for those of you who've not seen it to give it a watch, because I know that I have learned a lot from it. And now I am so excited to kick off the next leg of this Investing Masterclass, which is the importance of having defensive assets in your portfolio. So over to you.
Thanks for popping over to Sherpa HQ, Himangi. It's great to have another evening here on a very warm Sydney evening. As Himangi said, we are looking at defensive assets today, and they are about helping you sleep better. So that's what we're going. So just a quick recap on where we started. Asset allocation, that is how you allocate your cash among the various asset classes, is the key to achieving your investment goals. In fact, the research suggests that it accounts for up to 90% of the returns in a portfolio. And so getting it right is pretty key. And those asset classes, we started off by defining the 5 Bs of investing, starting at the most defensive, that is generally the most stable, lowest return, is bills, dollar bills, which is cash and cash-like instruments. We move up a little bit into bonds and then even up a bit further into bullion. So those 3 asset classes together make up the defensive asset classes, and they're the ones that provide the ballast to your portfolio and help you sleep at night. The engines of growth are we call the growth assets, and these are the ones that are capable of delivering returns in excess of inflation, which is pretty important in any long-term portfolio. In many ways, particularly for retirement income, inflation is the #1 enemy. And growth assets are what we call bricks and businesses. So bricks is real estate and infrastructure, and businesses is companies or shares. And in the last episode, so episode number 2 in this series, we focused on growth assets, and tonight it's the turn of defensive assets. And for many people whose investment journey began after the GFC, so from 2009-10 onwards, it can be tempting to be dismissive of defensive assets, but the last 14 years is a very unusual period in which both bonds and equities moved largely in one direction as interest rates came down and money became cheaper and more freely available. And that turned around a bit from 2022. And in 2022, both bonds and equities both returned double-digit negative returns, which is highly unusual. So you really do need to be looking at the long term when it comes to investing. 1 year, 2 year, 3 year, 5 years returns don't tell you the full story. So tonight we're going to focus on the largely unloved defensive assets, and hopefully by the end of today you will have a newfound love for defensive assets. So in the case of defensive assets, they're more likely to generate lower returns with a much lower risk of losing money. And these are the things that allow you to sleep at night and keep your finger off the sell button when turbulence strikes the market. Not only does asset allocation drive your returns, but it also is key to helping you stay the course. And we know that staying the course is the key to getting the market returns into your pocket. So having said all of that, now let's move on to our 3 Bs in the defensive assets. The first one that we're going to start with is gold. This B is B for bullion, which is really shorthand for commodities generally, but from a retail investor perspective, the one that particularly matters here is gold, and that forms an extremely useful place in our portfolios, particularly for Australians. And gold tends to have a safe harbor status. That is, it's somewhere where investors turn when markets get turbulent, when inflation rises, when times get tough in general. And it's priced in US dollars. So notwithstanding that Australia is one of the world's biggest producers of it, it is priced in US dollars. So when risk is off, times are getting tough, investors flee to the US dollar and they flee to gold, which means that the Australian dollar tends to fall. So not only does gold get some demand, but its values in US dollars goes up as the Australian dollar, so its value in Australian dollars rises as the Australian dollar falls. So it provides a double whammy for investors who live in commodity currencies. So Canadian investors, Australian investors, and to a lesser extent, South African investors. So it's an important part of portfolios, and it serves as both a stabilizer, notwithstanding that over the last 20 years, the gold return has been comparable to Australian equities returns, and its volatility has been higher. So those two things might seem to run against the purpose of defensive assets. But the beauty is that that volatility tends to be in the opposite direction to the other volatility. So when you mix it, you get this beautiful smoothing effect. We'll come back and have a look at that in episode 5 when we look at pulling all this together and building a portfolio. So if you want to invest in gold, you could of course go and buy some physical gold, but from a practical perspective, there are 4 ETFs that invest largely in gold. All of these funds track the physical gold price in gold, PM Gold, and NUG all track the US gold price. QAU is hedged, and QAU allows you to facilitates the delivery of physical gold. That's how the ETF price is managed, but it's delivered in Australia. The other gold and NUG both delivered in London, and Perth PM Gold is issued by the Perth Mint, and which is supported by the West Australian government. So you would think that the and it differs from the other three because it's actually a derivative. So it's effectively a certificate that entitles you to buy gold from the Perth Mint, and that obligation is guaranteed by the West Australian government. And it's also the cheapest of them. We are very concerned about the Perth Mint's compliance track record. It's had a number of controversial positions, so we are both concerned about the structure and its compliance track record. So notwithstanding that it's the cheapest, we don't recommend it. Gold is our preferred provider here. It's by far the biggest. It's the oldest by a couple of months, so it's slightly older than PM Gold, but it's got 20 plus years of history. NUG is much more recent, and whilst again it's cheaper than gold, it hasn't been around for that long. So, and we don't like QAU because it's hedged into Australian dollars. And as I started this presentation on gold by mentioning the fact that gold is priced in US dollars, so you actually want that currency exposure because that's what gives you the double whammy. So by hedging away the currency benefit, you lose that. It's also more expensive. So gold is our pick there, these funds tend to be a bit more expensive because of the cost of storing physical gold. In the case of gold, it's in a warehouse in London, it's specifically identified numbered bars. So that costs money to store and secure, and so you see these are slightly higher management fees than an equities or a bond fund generally. But we see gold as having a very important part in a diversified portfolio, and certainly the last 20 years have been particularly kind to gold, and so that's gold, the first of our defensive Bs. Just in terms of what that looks like, you can see that PM Gold and gold have largely performed over the last decade very close. So there's 9% over 10 years, which is sort of just under 1% a year. That might seem attractive, but it does move around a bit. You'll see that at the very right hand side of that graph there is an upkick in the PM Gold that's not in the gold. So there are some significant timing difference for these funds. So I wouldn't read too much into that, but you would certainly expect to see the difference in the fees reflected in that return. But we just don't buy the compliance track record of Perth Mint right now. So that's gold. So again, why do we like gold? It's the biggest fund. It's got $2.7 billion. It's marginally older. It's backed by physical gold, but it does have a higher return. We like the benefits of gold. So if anyone's got any questions on gold, please feel free to get in the chat. It is controversial, and of course Warren Buffett's not a fan, but I'm not sure that's something that I would take as a particularly negative. Which then brings us on to probably the most familiar asset class in the defensive category, that is bonds. And we look at bonds in two key categories, that is Australian bonds and global bonds. They are, both important, but when you first start looking at adding bonds to your portfolio, the usual place to start is with local currency high-grade bonds. So from a portfolio construction theory perspective, you want to mix the so-called risky asset, in this case your growth assets, with some so-called risk-free assets. Now, there is no such thing as a risk-free asset, but an Australian dollar denominated bond issued by the Australian government is as close to risk-free as you can get in Australia. There are obviously price fluctuations along the way, but if you buy a 10-year Australian dollar bond issued by the Australian government, you will get your money back on maturity, because the Australian government can print as many Australian dollars as it needs to redeem these. And so they tend to be relatively low return, and there is a range of that. So starting, if you're adding a small portion of bonds, which typically you will in a high growth portfolio, you might have 10 or 20% allocated to fixed interest. So the first point is to start with local currency high grade bonds. And that largely means Australian government bonds. It can also include state government bonds and government instrumentality, so things like the NBN, things like the National Housing Finance Corporation, which have a de facto government guarantee. So with the choice, you can go for pure government bonds, so AGVT and GOVT and RGB are pure Australian government bonds. They tend to have a longer maturity profile because the government can issue very long-term bonds and people have to buy it. IGB is a shorter duration fund that focuses on short-term government bonds, and VGB is in that short end as well, but it does have a longer duration. Both IAF and VAF track the same composite index, and they both of those have a smattering of very high-grade corporate bonds, very much investment grade, but both of them have about 10% high-grade government bonds, which have the benefit of kicking up your yield a little bit. And the 10% high grade is probably not enough to create a material default risk. So the extra yield kick up, I think, we believe is worth looking at. So our preferred option is IAF or VAF. We tend to use IAF, but they are largely indistinguishable. As you can see here, over 12 years here, there's what's that, about 17 basis points between them in total return, and it's almost impossible to see the differences on that graph. So you can treat IAF and VAF as indistinguishable, but they do both have a small allocation to very high grade corporate bonds, and that's why they are preferred. They both track the same index, they both got the same duration, they're both 97% invested in A grade or better, 70% of that's AAA, which is as good as it gets. They both include a smattering of high grade bonds, and the other bond funds tend to have a longer duration, lower yield, and by virtue of being longer duration, they are more sensitive to interest rate changes. So for all of those reasons, we like the slightly shorter duration that's long enough to get an uplift from falling interest rates, but it's not so long that you need to worry about extreme sensitivities. So IF or VAF is our preferred option there. And that's really all you need if you, in terms of bonds, if you've got a very small allocation to bonds. So if you're in the 10% type allocation to bonds, I would be sticking with the domestic high-grade bonds. And when you start cranking that up, you need some global exposure. And the main reason you want to add global exposure is for diversification in issuer and for diversification in structure. So Australian bonds, there's not a lot of variable bonds, so there's not a lot of non-government fixed rate bonds issued. Many of our corporates head overseas, so Qantas is a regular issuer in the 144A market, which is a US over-the-counter market, and it's hard to get diversity of issuer here. So to get diversification of issuer and structure, you need to move offshore, and you generally want to look at a hedged offering because you don't want to be adding currency risk into the stable part of your portfolio. You're going overseas to get diversity in tenor, diversity in issuer, and diversity in structure, but you don't want to be adding currency risk. The other advantage of hedging bonds is that as Australian interest rates tend to be below our global competitors historically, particularly the US, the swap back from US dollars to Australian dollars will give you an uplift in the yield. So that's another good reason to hedge it. Hedging bonds, because of their fixed duration, is a very cheap and easy exercise to do. So most of the global bond funds you will find are hedged. So both VBND and VBND is our preferred allocation here. It does have some very high grade corporate bonds in it. The AESG is an interesting one, and we think the jury's out on this one. So that applies a sustainability screen to those bonds. What that means in practice is, I think the jury's still out on that one. IHCB is a corporate bond offering, so you're moving up the risk curve a little here, we'll come back and talk about this when we move on to credit later. So credit is a code for higher risk bonds generally, where you're looking at less stable issuers, lower rated issuers. IHCB has some lower rated issuers in there, and IHHY is moving into the high yield bond, which used to be called junk bonds when I started in the market. So in the 1980s, they were generally referred to as junk bonds. We now call them high yield bonds, which sounds much less dangerous. So they are the main options. You'll find some of the racier stuff when we come to look at credit later. Again, summarising why we like VBND. It's hedged high quality bonds. It's got a slightly longer duration than our Australian allocation. Its average grade is slightly lower, that AA. It is heavily exposed to North America, which is the biggest bond market in the world, and for our purposes, it's got very limited exposure to emerging markets, which we think emerging market debt belongs more in a credit allocation than in a bond allocation, and that's partly why we don't like ASG. not sure about the screening methodology yet. It's not that old. And it's 9% invested in China. Now that's US bonds issued by the Chinese government generally. So it's not yuan debt, it's US dollar debt. And you know, China's a big holder of US government bonds, so it's a natural hedge for China. So I don't believe that that's a particular financial exposure, but there is always the question mark over the rule of law in China. So need to be treated with caution. So we just don't see the benefit yet. And so that should take you up to a 20, 25% bond allocation. And if you're going beyond that, I think you need to start looking at some of the high yield stuff, which we'll come back to when we talk about credit funds. And before we do though, it's time for Himangi to show us some of the new and exciting asset allocation tools in Sharesight. We at Life Sherpa are big fans of Sharesight. Our pro members get a free Sharesight account, particularly for asset allocation purposes. So while Himangi is getting set up on her little demo, might be time to take a few questions. So Lisa asks the question, why would you buy bond ETFs rather than individual bonds where you get the full price back on maturity? That's largely about size of holdings. So if you had enough money in bonds to buy individual bonds to make up the same portfolio, that's certainly something you could do, but that's probably something for a double-digit millions bond portfolio. And that I've seen this around on Reddit quite a bit. This notion that you get the full price back on maturity, which is true for the bondholder, but it's also true for the ETF. So the ETF, if it holds the bond to maturity, it will similarly get the full face value. There is a bit of trading happening in ETFs. Ones like VBond don't have huge turnovers. When you look at some of the racier stuff, which we'll look at in credit, Coolabah, run by Christopher Joy, is probably the biggest bond fund manager in Australia, and their average hold period in some of their funds is 8 days. But when you're looking at a healthy government bond fund like VBond or IAF, they're holding them long term, and generally not necessarily to maturity. Like few investors buy 30-year bonds to hold them for 30 years, unless you're an insurance company or an annuity issuer where you're trying to match liabilities on the other side. But for most bond investors, they will trade based on views on where the yield curve is going, what its shape changes. They will maybe forced to trade when bonds get downgraded. But for most normal investors, buying individual bonds, certainly for your core bond holding, doesn't make a lot of sense. We see older investors, sort of retirees, looking at this for, with good size portfolios, could certainly look at buying individual corporate bonds particularly. There's often some very good value to be achieved there. So you can buy Qantas 10-year bonds today and get 9%. You can buy CBA bonds and get 6.5%. So there is a place for those, but where you're using bonds as ballast in a largely growth portfolio, you should be starting with an ETF. Himangi, over to you.
All right, so We basically have been establishing that asset allocation is the key to achieving your investment goals. And at Sharesight, we do have a couple of tools, if I may add, that might come very handy in visualizing and defining your own asset allocation strategy. Now, again, this is a sample portfolio that I have in front of me. This is just general advice, and it is not financial advice.
Yeah, I have a license to give financial advice. So if you want financial advice, listen to me.
From me, you're just going to get a sample portfolio and how you can take this financial advice, apply it to you, and run.
But I should point out, it is general advice, not personal advice.
Yes, that is.
And it hasn't taken into account your personal circumstances. Read the PDS and TMD before investing. And consider taking professional advice.
Yes, that is exactly what I wanted to say, and you captured it very well. Thank you. Well, anyways, what I was getting to is once you have an asset allocation strategy decided as per your own personal investment journey, we have a handy tool that comes into play called a custom grouping tool. Now, let's look at this portfolio, right? This is a sample portfolio with A to B holdings, which I've picked and chosen basis of the sort of investment strategy I have. Now, what
and number go up too. That's good. That's a good portfolio. It goes up and to the right.
Thank you. I wish this was my portfolio, but it's a sample one. Anyways, now what it enables me to do, this portfolio essentially, so if you have a Sharesight account, and no matter if you have one holding or maybe 10 or upwards of 20, you can actually group your investments and your holdings by something called as a custom group. Now, let's look at this one. For example, I have 3 custom groups that I've made. One that picks up growth assets, including equities and ETFs that I think are growth assets in my investment journey. Alternatives, we've got gold, PM gold, and then I have my defensive assets, which are the ones that I think provide a good defense sort of value to my portfolio, preventing it from any shocks. I can continue to add a new category, name it as per what I want, and then sort of move it around. But when in action, the best way to use this custom group is to just see how you can visualize your portfolio's performance. Another thing that helps you with this is our reporting tool. So once you have your groups, now I'll go into my grouping that we just saw earlier. Now, there you go. Now you have all your holdings in a grouping. So there's growth, alternatives, and defensive. Now, this is my own personal investment journey that I've decided to group these by. Anybody from an experienced to advanced investor or a beginner one, you can choose these groupings according to you. These could also be by market type, sector type. Now, I've just done it this way. This way, I can actually go into my reports and then lead over to run a diversity report. Now, essentially, a diversity report is just there to help you visualize your diversification in the portfolio. Now, if I go on run report, and I have shortlisted it by my grouping, the same one I did, there you go. I have a good picture snapshot of the percentage in which each of the groupings that I've placed in. So you can see growth, alternatives, defensive up in the percentage. And now I can make a decision as to, oh, do I think that this is the strategy I wanted for my portfolio as asset allocation or no? This really gives me a snapshot along with each sort of value that is attached to all my holdings. Now, to get like a much more deeper analysis, a lot of our subscribers at Sharesight, they like to also run a report called the contribution analysis report, which is also back here in our reports tab. And it essentially explains all the drivers that are behind your portfolio's performance. Let's look at it here. Now, again, it's custom by, we have default groupings like market, currency, but I want to go by asset allocation as my grouping. So I go to my grouping here, and then I choose a date since inception. Now let's look at how my assets have been performing since the time I bought them, which was not very long ago. And there you have it. You have a good idea as to which part of your portfolio is actually contributing to the growth. And in this case, not so much of a growth here, but I can see the percentage changes. I can see the fluctuations. I can also filter it by percentage. And this essentially just, I mean, an experienced investor would obviously know that, you know, there's outperformers and underperformers that actually define your portfolio's performance. But for even if you're a beginner investor, you get a good idea about, you know, if there's any stocks that I need to buy or sell, or is there something I need to focus more on. I mean, you would know, Vince, that if this was my personal asset allocation strategy, I could look at this report along with the diversity report to just sort of put everything in one place in front of me, and then make my decisions as and when you know, I choose to get more insights into a holding.
Yeah, certainly this contribution analysis is something that we focus on a lot in our investment committee meetings. Not that specific graph, but they're looking at the contribution of each category, of each security in each category, in terms of both returns and volatilities, and how that compares to the 20-year benchmark we use, and how it compares to what we expect it to do. And we'll talk about a bit more about this in episode 5, when we look at pulling all this together into constructing a portfolio from all these individual parts.
I mean, here obviously you can also add a benchmark, which I have not added, but it also enables you to install a benchmark in, map that with the performance as well. So it's quite handy. It's, you know, it's super visual. Yep. You get everything in one place. And of course, if you're a premium Life Sherpa, if you have a premium Life Sherpa account, you know that you get a free Sharesight account included with that subscription. It's a Sharesight Pro account, and these reports are only available for Pro account users, investor plans, and expert plans. But don't worry. If you have a free Sharesight account, you also get a 7-day free trial to try out these reports, have a go at it, and see how you go with all the recommendations that you get and you keep learning today and in the next 2 series going forward.
And your point about benchmarks is also particularly appropriate or pertinent here, because you know, when people say, "Oh, I did well," you've always got to ask yourself, compared to what? And that whenever anyone tells you, I've done really well in X, you've always got to ask, compared to what? You know, everybody did well in equities last year. So how did you compare to the benchmark? Now, what that benchmark is the bigger question. And ultimately, for most individual investors, the real benchmark is, did I achieve the return I need to achieve my goals? It sort of matters less whether the market did 20% or 22%, whether you did +1 or -1. What matters is, are you on track to achieve your goal? And that's really driven by your asset allocation. Sure, when you're looking at the part of your portfolio that's allocated to Australian equities, you should be comparing that part of it to the ASX 200 or the ASX 300 or the ASX 50, depending on what you're invested in. But there is zero benefit in comparing your equities portfolio to a balanced portfolio benchmark. So the benchmark has to be related to your goals and related to what you're actually invested in. So answering that compared to what question is really important.
Yep. So, and obviously you can visualize what returns you made by simply just putting them in there. Again, we can revisit adding a benchmark in the next one.
Yeah, sure.
And well, I think we have time for one more question before we finish the slides, and then we can revisit the questions again.
So Nathan asks, how are bonds priced compared to equities? And mathematically, they are very similar in the sense that it's all about trying to apply a price to a set of cash flows. So in a share, generally there is a consensus view of what the cash flows from this in a share, we usually measure it by a PE ratio, a price to earnings ratio, but essentially the analysts who look at these things look at the future cash flows. So in a business, that's revenue minus expenses equals profit. So what multiple of profit how do I bring that back to a present day value, and generally using techniques like net present value or internal rate of return, which generates an expected price, and then we benchmark that using a price earnings ratio generally. With bonds, it's very similar, except the cash flow is now much more defined. So if I buy a Australian government bond, let's say a 10-year bond, it's going to, if it's issued, it's a $100 bond face value, and it pays 4.5% coupon, then I know I'm going to get $4.50 every year for 10 years, and in year 10 I'm going to get my $100 back. So if market value that at a 4.5%, that was the fair return on that bond, then that bond is worth $100. If, on the other hand, the market considers that the return that it wants for Australian government 10-year risk is 3%, then people will be prepared to pay more for that that bond than $100. So you'll still get your $4.50 coupon, but you might now have paid $105 or $110 for it. If I had my HP 12C, I could tell you what the actual number was, but it's a number that's more than 100, and so that you get that excess price back through the coupon over the time, and you end up with $100. So you actually make a capital loss on maturity, but the yield to maturity then is the market rate, in this case, what did I say, 3.5%. And that's it seems like fairly complicated maths, but only because it's sort of in your face compared to shares. But the mechanism is broadly the same. That it's, what's this future cash flow worth at today's expected return? And for a bond, when expected return goes up, price goes down. When expected return goes down, the price goes up. So a bond market rally implies falling interest rates. So rally meaning going up means that interest rates or expected return has fallen. Whereas when you look at shares, you get a falling price gets recorded as it can either be because the future cash flows have fallen, or the market's expectation of future cash flows have fallen, or the market demands a higher return for the same set of cash flows. And we express that generally as a price to earnings ratio. So it's all about turning a future set of cash flows into a value today. In the case of bonds, we just know what those cash flows are to a much greater level of certainty. So moving on to credit then. So as I said earlier, credit has become code for higher risk fixed interest. These are generally still fixed interest instruments. And in fact, that's an interesting word. The word fixed interest comes from the days when bonds were generally fixed rate. So historically the government bonds were issued at fixed rates, and they became known as fixed interest. It's probably better, to describe them as fixed income securities today. That the interest rate, you can have a variable rate bond, and in fact much of the issues in Australia are variable rates. So our banks issue lots and lots of variable rate debt. Our corporates issue a bit of variable rate debt in the local market, which is why they tend to issue their fixed rate debt offshore, where there's much greater demand for it. But think about fixed income or fixed interest as a well-defined set of future cash flows that aren't dependent on the profitability of a business, and you don't share in any upside from that. You have a fixed return defined by the cash flows inherent in the instrument and the price that you pay for it. Credit, on the other hand, is now moving up the risk curve. So we're either looking at longer dated ones, lower credit risks. So when it comes to credit, we are moving up the risk curve. So we're certainly moving into corporate issuers and asset-backed securities. And those two behave quite significantly differently. So it's worth understanding what's inside these bonds. Generally, there's a lot of bank issuing stuff, which is fairly secure stuff. We then get into corporates, and there aren't that many investment grade corporates in Australia. And so by investment grade, it's probably worth touching on that quickly. So there are three main credit rating agencies, and they assign a credit rating to a bond or an issuer. And they're all slightly different, but effectively a credit rating is a forward-looking measure of the expected loss rate. So they start at the very top with AAA, which is as good as it gets. In Australia, federal government Australian dollar denominated debt will be rated AAA. There are no Australian AAA rated banks. And then you start moving down AAA, AA, single A, triple B, double B, which is the investment grade pieces. There's a little bit of debate whether investment grade begins at triple B minus or double B. It used to be triple B minus, it's now double B. So Qantas is probably our biggest corporate that's at the lower end of that. And as you move down those ratings, you should expect a higher return. You should also expect a higher return for longer duration. So credit rating and duration are the two factors that drive bond returns. And so if you want a higher return, you either have to accept a longer duration or a lower credit rating, or both. So if the lowest return you can get is probably buying 90-day bills from Commonwealth Bank, and that was probably paying very slightly over the swap rate. But if you want longer term, so 10-year Qantas debt is 9 today probably. There was a time when Fortescue debt could have got you 19, but that involves deep analysis of the underlying issuer, which is probably not practical for most retail investors. So moving up to credit card, CRED is a investment grade corporate bonds. So it'll have banks, it'll have BHP, it'll have all those sort of things. Coupon is senior bank debt. So the word senior is an interesting word here. So senior means it's the highest ranking debt in the credit stack. So senior, so secured, senior, junior, subordinated is the ranking order, and all of those rank ahead of shareholders. So a senior floating rate bond means it's unsecured, but it's senior, so it ranks at it's the first to get paid, and it's floating rate because it pays a variable interest rate. So they are usually priced off the bank bill swap rate. The ICOR is again corporate bonds, so that's sort of quite similar to cred. IYLD is moving a little bit up the risk curve, so it's largely debt of non-banks. Sub D is investing in subordinated debt, so that's often in what we call asset-backed securities. So you may have heard of securitized home lending. So if you're a non-bank in Australia, what you will usually do is you'll issue bonds secured on those mortgages, and the first tranche of those is the most secure. That's the first one to get paid. So that's quite often going to rate AAA. So you might take 1,000 or 2,000 home loans, because individually there's a fair chance that some of those might default, but you put 1,000 of them together, and the first 80% of that is almost certain to get paid, and so that's going to get a AAA rating. Then the next tranche will step down, and eventually you end up at something called subordinated debt, which gets paid out when everyone else has got paid out. So you should expect a higher yield for that, and it's probably more expensive to invest in because it's takes a lot more analysis. HBRD is a very interesting one. So that's an active fund. This is managed by Coolabah, Christopher Joy's fund, and it invests in what are known as hybrids. So they are instruments that are a bit of a mixture between equity and debt. That they generally have a fixed coupon, which often in Australia attracts franking credits. So they've got enough equity characteristics to get franking credits, but they suffer some of the disadvantage of equities. These are really good for yield here, but you've got to know what you're doing. These are not, so you might see them on the stock exchange. There's CBA Pearls, there's most of the banks have a variation on them. That's not something I would invest in without a active manager, and HBRD is managed by a really good hybrid manager. And then looking at floating rate notes. So all of these have very distinctly different credit behavior and have a very different place in your portfolio. If you've got more than 20-25% of your portfolio allocated to fixed interest, you probably need to be starting to look at a smattering of these. Where you go will depend on how big that is and what your goal is. If I were a retiree with a 40% fixed interest allocation looking for yield, hybrid certainly would have a place in that. IYLD might have a place in that, and maybe a smattering of sub-debt. So these are our preferred listed opportunities in this space. But every one of these behaves differently, so we can't say that there's a preferred one of these because they all fulfill subtly different roles. And really this is a place to play if you have a large allocation to fixed interest. So for most younger accumulation investors, which probably the largest part of our audience tonight and over this series, you're probably not going to be in that category. That more than 20 percent allocated to bonds is a fairly conservative portfolio, particularly when you've got some other defensive assets like gold in there as well. So this is a fairly complex area. Takes a lot of research, and getting access to the research on the underlying instruments is not easy, and particularly when it comes to asset-backed securities. So lots of traps for young players there, but probably not all that relevant to tonight's audience. Which brings us on to the fifth B, or the third defensive B, being bills or cash. And cash can mean a number of things. It doesn't just mean the actual folding stuff. So this category is an alternative to bank deposits. Generally won't be a beneficiary of the bank guarantee because most of the underlying holdings will be above the threshold. But the advantage of having instruments like this in your portfolio is they're in your brokerage account, so they're readily accessible for buying and parking cash for the short term. There's certainly compared to AAA, there are places where if you're prepared to work hard, there are probably places you can earn more on bank deposits, and depending on what your allocation is, you may also get the bank guarantee. But for us, this is really about having the money in your brokerage account, readily accessible, and ready to be deployed. So looking at these ones, these are largely bank deposits or bank bills. The more bank bills you're going to get, the more return you're going to get. So in our case, AAA is our, just having a look at those. If you look at the comparisons, you'll notice this is the smoothest graph you'll have seen all night. It looks like a spline curve, but it's very smooth, very stable. There's not a huge amount of difference between these. Admittedly, this is a period when interest rates were particularly low. So over that 7-year period, or almost 7-year period, AAA has delivered you 12.7. The iShares Enhanced Cash Fund is 12. Core Cash 11. So that's a period when interest rates were extremely low, and there's not a huge amount of difference between these in terms of return. As interest rates rise, you might expect the gaps to rise, but our preferred investment in this space is AAA, and it has consistently outperformed the RBA cash rate since 2012, so it's over 12 years. It's marginally outperformed the alternatives, but it is invested primarily in bank deposits, with 30% of those in more than 30 days, up to 90 days. It's the biggest and the oldest, and it's a really convenient place to keep cash in your portfolio. Looking at some of the other components, Bill is more liquid, but you pay for that in returns. And ISEC is including stuff with a bit higher yield. So looking at some of the buzzwords here, floating rate notes, we talked about those earlier, FRNs or floating rate notes. Commercial paper is generally 90-day paper, effectively IOUs issued by banks and major corporates, typically 90, 180 days. There were some structures, don't know if anyone remembers Rams Home Loans, but it was funded by this very novel instrument called extendable commercial paper, which allowed the issuer, being Rams in this case, to extend the maturity date. When it got to 90 days, it's got, oops, I didn't, I'd rather keep this now for another 90 days, so I'll give you your money back in 3 months. Slightly higher yield, but it all came a cropper when liquidity dried up in the market in 2008. So need to be careful about some of these structures. Novelty isn't always a good thing when it comes to investing. So we're not convinced that there is any real uptick in yield that makes it work. So AAA is our preferred option here. And I think that takes us to the end of the formal part of this, and we can now turn to questions. A lot of people ask me, well, why should I buy bonds that have given me 2.25% over the last decade when I could have had shares that generated 8%? And it really is around having the right tool for the right job. So, think about it like a football team. You don't want a team of strikers. So if you had 11 Lionel Messis on your team, you're unlikely to be a championship winning team. So a team of champions doesn't necessarily make for a champion team. And the same is true with constructing a portfolio, that often the mixture of the two gives you a better return than either of them individually. And we'll see that when we come back to constructing a portfolio in episode 5. So it's the mixture that matters. That we start with an overall return target, and then that tells you a return and volatility target, and then that tells you what you should invest in. But we'll come back to that in episode 5. I don't want to preempt the finale. So the question is, are cash and gold equally unpopular, and what would you suggest beginners can invest in? Great question. There is a general belief in the market, particularly if your experience of investing began in 2009 onwards, that equities only ever go up. And it's been a remarkably smooth ride. Central banks have been pouring money into the economy. Money's been cheap and easy. Interest rates have been heading down. The economy's been reasonably good, and we've had low inflation. And if you look at the investment returns, it's the second highest returning 14-year period in history. And when you factor inflation into that, it's the number one real return 14-year period in 120 years. So it's not surprising that people get lulled into the cult of equities. But history will tell you that diversification is your friend. So cash is in some ways the most dangerous place to invest. Now I know that sounds a bit strange, that it has the lowest volatility, has the greatest certainty that you're going to get your principal back, but you're also by definition accepting that the purchasing power of that cash is getting whittled away by inflation. So we haven't had positive real interest rates, that is where a bank deposit could yield you more than inflation for very long periods of time. Inflation over since 1947, when the CPI index was established, has averaged just over 3%. The central bank or reserve bank is tasked with keeping it between 2 and 3%. But that still means that your purchasing power is going to halve in 24 years. So if you're planning for what could be a 40-year retirement, cash is probably the most dangerous place you can be. You need some, because you need to spend it. You need to have powder dry to take advantage of opportunities, and you certainly don't want to be selling equities in a down market. So some cash is essential, and the question is how much. So once you get beyond your emergency stash, small amounts of cash for accumulation investors. And by small, I mean single-digit percentages. Gold being unpopular. I mean, gold is a very controversial asset class. There are those who poo-poo it. Warren Buffett's a known gold skeptic, but history has proven him wrong. And we focus very much on the evidence, that we are evidence-based investors. We don't believe in trying to predict the future. We don't read tea leaves. We don't do voodoo charts. We look at what the evidence shows. And certainly since the world came off the gold standard, Richard Nixon took the American economy off the gold standard in 1972, I think, somewhere between 69 and 72. And since then, just briefly, the gold standard was most currencies were exchangeable for gold, at least in theory, if not in practice. And the value of the US dollar was defined relative to an ounce of gold. And many other currencies, the pound, for example, was also linked to the price of gold. So up till that early 70s period, the price of gold was largely fixed because currencies were fixed against it. Since then, it has currencies have not been fixed to gold, and the gold price has formed a relatively stable benchmark against those. There have been some tough times. In the mid-90s, the gold price got down to 400 Australian, which is very low. Today it's at 3,000. So over the last 20 years, a period that includes the tail end of the dot-com crash, it includes the GFC, it includes the COVID period. Gold has been a stabilizer and has actually returned, probably historically more than you might have expected. It's also, if anyone's got any graphing software, if you look at the graph of a gold portfolio during the COVID flash crash, so February 21, 2020, the Australian market peaked and plummeted very quickly. It recovered by about June, but the gold price just went, in Australian dollars, just went straight across that dip. So it's a natural hedge. People poo-poo it because it doesn't generate income. It can generate income. Generally, although none of those funds I mentioned do actually generate returns from leasing the gold. And generally, the forward price of gold is above the current price, so there is a contango to be earned. Again, none of those funds take advantage of those, but you can generate income from gold despite the myths. There are opportunities to borrow in gold. I worked on the funding of the Gold Ridge gold mine in the Solomon Islands in 96, 97, and we organised a gold loan to fund it. So natural hedge for a gold miner, that they borrow in gold and they just dig the stuff out of the ground to repay it. So their bet is that they can dig it out of the ground for more than they paid to buy the mine. As it happens, when the government fell and the rebels overran the mine site, the Commonwealth government ended up paying out on the insurance on the mine. So that's just an example. These things happen all the time. That's just one example. So gold can generate a return. None of those funds do. There are unlisted opportunities to benefit from that, but there are no Australian listed ETFs that do. So you need to understand why you're buying gold. And the fact that its main use, its actual uses, industrial uses, are really jewellery, and you can see the impact of economic growth in India and the Middle East in particular drives that value, and it's increasingly used as part of electronics. But almost all of the gold ever mined is still in existence, and Australia is a great producer of that. So all of these things have their place. There is no one intrinsically best investment. So, if anyone asks me, what's the best ETF to buy? The answer is it depends, and you really have to go back and look at why you're investing, and that will tell you what you should invest in. So that's gold. Sorry, did you want to take the talk about the special offer?
Yes, so we have an offer for everyone who's joined in on this webinar with us. We will be sending you an email, of course, with the link to watch the webinar replay. And this is a great deal if you really want to get your hands on that book.
Who wouldn't want to get their hands on the book?
I think that this is a great deal that everyone should take advantage of, as long as you can. We'll be sending you the details of this offer in the email that comes after this webinar, so stay tuned. If you've joined us for the first time, and if you're rejoining us for the third one, thank you for spending this last hour with us. We hope you had a good time, and we're so excited to be doing this again. See you at the next Investing Masterclass.
And in case you missed episodes 1 and 2, they are available on
the Sharesight YouTube channel. Just log on to youtube.com/Sharesight, and you will see the first 2 webinars up on there, along with the third one, which will be uploaded in the next few days. So,
if your portfolio is not on Sharesight, is it really a portfolio?
Is it really? Is the question that I would like to end with.
So, with that, it's good night from
me.
It's good night from Himangi, and we'll see you in episode 4.
See ya.